We're going to try something new today. Let's get started with a look at the 2008 financial crisis in the United States and how the government responded to it. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. The financial crisis of 2008 affected many people. According to Ben Bernanke, a global financial and economic crisis like the one that occurred in the 1930s could have occurred with the disastrous results. What occurred after that? What was the cause? Is it not time for us to get together as a raiding group to take gas from other tribes in the wasteland? As a side note, we survived the financial crisis, and things have improved. So if you're doing that, put down your crossbows. A quick primer on mortgages will help us understand what happened. But if you ever had a mortgage, you'll know that you'll typically borrow several $100,000s from a bank. Because of this, the bank receives an agreement known as mortgage, in which the homeowner must pay back part of the principal, plus interest, each month to the person or organization that has the document. It's a default if they cease making payments, and the house belongs to whoever has that piece of paper. For this reason, I'm referring to the person or entity that has the paper, rather than a bank as the initial lender. Because something happens so frequently, I use the word often in this context. In the 9 months after I purchased my home, the mortgage has been held by 3 different financial institutions. Mortgages have traditionally been difficult to obtain if you have a poor credit or a stable job. In the early 2000s, lenders were reluctant to take on the risk of a borrower defaulting on a loan. As an aside, the tale becomes complicated quickly and is a fascinating one, but we're trying to keep it as easy as possible. The US housing market became a popular investment option for investors searching for a low-risk, high-return investment in the 2000s. As a result of the low interest rates on the US government bonds, investors thought they could receive a better return from mortgage interest rates than they could be investing in these bonds. However, substantial sums of cash, it was too much effort for global investors to just buy up mortgage and stand and deal with us individually. I mean, we're the ones who are footing the bill. Investments in mortgage-backed securities were purchased instead. When huge financial organizations pull their mortgages, they form mortgage-backed securities. What they do is simply buy up hundreds of individual mortgages and combine them into a pool, then offer shares in that pool to investors. A higher rate of return than other investment options, and the perception that they were safe bets attracted investors to these mortgage-backed securities. For one thing, as property prices rose, lenders reasoned that even if the borrower defaulted on the loan, they could simply sell the house for a higher price. The same time that credit rating organizations told investors that these mortgage-backed securities were safe investments. Many of these mortgage-backed securities received AAA ratings, the highest possible, at a time when mortgages were only available to those with excellent credit. Investors, for their part, were eager to acquire ever greater quantities of these instruments. As a result, bankers worked hard to help construct more of them, but they required mortgages to do so. Lenders then began making loans to borrowers with weak credit and little income. These loans are known as subprime mortgages. Eventually, predatory lending methods were even used by some organizations to manufacture mortgages. Lenders provided loans without checking borrowers' income and offered ridiculous adjustable rate mortgages, with payments that were initially affordable but quickly grew out of reach for many borrowers. However, with these new subprime lending methods were so new, credit rating organizations were able to cite to historical data that indicated that mortgage debt was a safe investment. However, investors didn't lose faith in the ratings and continued to pour money into them, not the investments. There was an even more unsafe product called collateralized debt obligations, CDO, that was being sold by traders. And even though many of these investments were made up of these highly risky loans, they had the highest credit rating from the rating agencies. Investors, traders, and bankers all pumped money into the US housing market, and the price of homes continued to rise. As home values rose, as a result of the new lax lending standards and low interest rates, mortgage-backed securities and collateralized debt obligations appeared to be an even better investment. That magnificent mansion would still belong to the bank if its debtors failed, right? There is nothing wrong with this. Let's head over to the thought bubble now. Let's take a look at the housing bubble, which was characterized by rapid price increases, fueled by irrational judgments. I'm sorry, but this was just a bubble, and bubbles collapse, and this one did. Because people couldn't afford their soaring mortgage payments or their astronomical housing prices. Defaulting borrowers put more houses on the market, but there were no buyers. So, supply increased and demand decreased, resulting in a drop in home prices. Some borrowers were saddled with mortgages that exceed the value of their homes when values decline. Defaults led to further declines in housing prices as large financial institutions stopped purchasing subprime mortgages, leaving the latter with bad debt. Big investors who poured money into mortgage-backed securities and CDOs began losing money on their investment in 2007, after some of the biggest lenders went bankrupt. But wait, there's more. Financial institutions also used another financial instrument, unregulated over-the-counter derivatives, such as credit default swaps, which were essentially sold as insurance against the default of mortgage-backed securities. Is AIG familiar to anyone? When things went wrong, it sold billions of dollars worth of these insurance products without having the money to back them up. Traders were able to make huge bets on whether the value of mortgage securities would rise or fall, thanks to these credit default swaps, which were later turned into securities. As a result of these bets on financial instruments, a maze of assets, liabilities, and risks was created. When things went bad, the entire financial system suffered. As Lehman Brothers went bankrupt, other large financial institutions were forced to combine or needed government bailouts. One of these financial firms had balance sheets that no one realized was particularly terrible. These complex, unregulated assets made it difficult to tell, and panic set in trade, which caused the credit markets to freeze, the stock markets to crash, and the US economy to enter a devastating recession. So what exactly did the authorities do? Much good came from the Federal Reserve's offer of emergency loans. With this measure, banks with solid foundations were shielded from the effects of irrational fear amongst their lenders. The Troubled Assets Relief Program, also known as the bank bailout, was implemented by the government and is known as TARP. In the beginning, this was supposed to provide $700 billion in bank bailout funds. As a result, it really cost $250 billion to bail out banks, which was eventually increased to include AIG and homeowners. With the help of the Fed, this helped stop the financial system from going into panic. Treasury also did stress tests on the biggest Wall Street banks, and government accountants looked at old bank balance sheets and said which ones were safe and which ones needed to raise more money in front of the whole world. This took away some of the uncertainty that made it hard for institutions to lend money. Over $800 billion worth of new spending and tax cuts were passed by Congress in January 2009. This helped stop the decline in spending and jobs. In 2010, Congress passed the Dodd-Frank Law, which was meant to improve transparency and stop banks from taking on so much risk. In addition to many other things, Dodd-Frank set up a consumer protection bureau to stop people from getting bad loans. It made sure that financial derivatives had to be traded on exchanges that everyone could see. It also made sure that big banks could fail in a controlled and predictable way. But there's no consensus on whether this regulation is enough to prevent future crises. What have we learned from all of this? One thing that led to the 2008 financial crisis was giving people the wrong incentives. It's when a policy has the opposite effect of what it was supposed to do. It's like mortgage brokers were paid more when they loaned out more money, but that made them more likely to make risky loans, which hurt their profits in the long run. Then we come to the moral hazard, which is when a person takes more risk because someone else has to pay for that risk. They are willing to lend because they know they will be able to sell the mortgages to someone else. Everyone thought they could pass the risk on. If banks know that the government will bail them out, they'll be more likely to make risky or even unwise bets. This is called a moral hazard. In Alan Greenpant's words, if they're too big to fail, they're too big. He said it very well. Whenever anything bad happens, people instinctively try to find someone to blame. But in the case of the 2008 financial crisis, no one had to look very far because everyone was affected. Failure to control and monitor the financial sector by the government has been blamed for the financial crisis. To paraphrase the findings of the Bipartisan Commission on the Financial Crisis, a large part of the century's absence was due to a widely held belief in the market's ability to self-correct and in the ability of financial institutions to efficiently police their own activities. According to the research, the financial industry's years of deregulation are partly to fault, and regulators themselves are to blame for not doing enough. Everyone in the financial system, from the largest financial institutions to ordinary borrowers, borrowed too much money and took too much to risk as a result of the financial crisis. In order to engage in hazardous assets, the bank took on massive debt loans, and a large number of homeowners took out mortgages they couldn't afford. This tremendous systematic failure should serve as a reminder, however, that it was caused by human faults within a system composed of individuals. When money was at stake, some didn't understand what was going on. Others chose to ignore the problems, and still, others were motivated by greed. The Financial Crisis Investigation Committee report should be given the final word today. To quote Shakespeare, they wrote, "The fault lays not in the stars, but in us." Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.